Welcome everybody to our 8th Digital Finance Summit. The timely theme is on financial services in the age of COVID-19. I encourage you to tweet about the summit using the hashtag CUDFS20. Again, hashtag CUDFS20. My name is Dr. Leon Perlman. I'm head of the Digital Financial Services Observatory, or DFSO, as you'll be hearing the term, project of the Columbia Institute for Tele-Information at Columbia Business School in New York. You can follow me on Twitter as well at Leon Perlman, again at Leon Perlman. A little bit about the Digital Financial Services Observatory. We really follow the business and policy of digital financial services, or DFS as we call it. A need was identified for a dedicated legal policy, technology and regulatory institute on digital finance, and the DFSO started its activities in 2015 as a project of CITI, and CITI was founded in 1983 at Columbia's Business School by Professor Noam, who we'll hear from shortly. The project is funded by the Bill Melinda Gates Foundation, a multi-year grant, and we thank them very much for the continued support. If you want to take a look at our website, dfsobservatory.com, you'll also find the program and the bio booklet of all the speakers and panelists today. There's a link on the homepage, so dfsobservatory.com. This is the agenda for the day. I'll keep this up. So the last time we had a Digital Finance Summit, we had a few hundred people packed into Columbia University's campus in New York City. But here we are now in quite extraordinary times, affected by this coronavirus scourge, unfortunately. I hope you're well, safe, and from the ravages of the pandemic, wherever you are in the world. Indeed, we now have over 600 viewers from over 35 countries on every continent, I think except Antarctica. Maybe the penguins are there logging in to view the summit. My thanks especially for those in Asia who stayed up very late to view the summit. We've got a lot of folks from Indonesia and that time zone who've logged in. Thank you very much. You'll hear today from our distinguished speakers sharing a wealth of experience and insights with us on four major themes that relate to responses and adaptation to the new normal created by the pandemic, especially as to how this affects the most vulnerable in our communities. We have sessions today on cybersecurity, as you can see on the agenda, digital financial services, fintech and blockchain, and a common thread throughout those sessions will touch on issues of social justice and gender equality. As I said, all the speaker bios are on the download link on the DFS Observatory website. In the interest of time, unfortunately, there won't be any audience questions today for any of the keynotes and panels. Speaking of keynotes, we've got two keynotes. First is from Chris Calabia, who is a senior advisor for supervisory and regulatory policy at the Bill Melinda Gates Foundation, and a good friend of the DFSO, who I said has been funded by multi-year grants from the foundation. So again, thank you very much. Chris was previously a banking supervisor at the New York Fed. After Chris is my good colleague, friend, Keith Bowie, who has led the development of a unique fit-for-purpose cybersecurity risk management framework aimed at assisting developing countries in their fight against cybercrime and fraud. We're really looking forward to that. He'll give the first public overview of the beta version of the risk management framework. Keith was previously CIO of Scotiabank, so is well qualified to speak on issues of cybersecurity. But first, I'd like to introduce my colleague at Columbia Business School, Professor Noam, who is Professor of Finance and Economics at the Business School and holds the Paul Garrett Chair in Public Policy and Business Responsibility. He is, of course, also Director of the Columbia Institute for Tele-Information. Over to you, Professor Noam, to provide opening remarks and scene setting.
Thank you very much. Thank you very much, Leon, for organizing this with your team. Good morning and welcome. I'm Noam. I'm the director of the CITI, Columbia Institute for Tele-Information. We've been around for a while. We produced over 75 books and hundreds of articles on topics of media, media tech, networks, digital industries, et cetera, et cetera. So one of our projects is the DFS Observatory. Thanks, Leon. Thanks, Jason. And for this event, thanks also Mike Wexler. You'll meet some other people from the team throughout the morning. And thank you very much, Gates Foundation and Chris Calabia. Let me say a few things in setting the theme, and I want to go beyond kind of the ribbon cutting aspect here. The topic today is the impact of the pandemic on financial services. First, let's talk about ICT more general in this environment. The good news. Imagine if all this had happened 25 years ago, without convenient work at home, without Zoom meetings, without e-health, e-commerce, distance education, SVOD, social media networking, without Tiger King. Online has saved the offline. The virtual has saved the real. Just look at this event here, 600 people, registrants, 64 countries or so on at the latest count, 24 people on the program, effortlessly interacting, or so we hope. Let me briefly talk about the three dimensions of the online experience during COVID. Infrastructure, applications, policy. First, infrastructure. Overall traffic has increased by more than 50% in the United States and by more than 40% in Europe. Despite this huge rise in traffic, networks in most OECD countries have worked with hardly a hitch, but not everywhere. One study tracked 138 countries and found that 72 of them had slower speed than pre-pandemic. 4 countries experienced speed declines of more than 40%. That's a lot. Libya, Hong Kong, well, probably they had their own civil unrest issues that affected it. The other 2 countries were Panama and Malta. Why? Maybe it's because of all that extra traffic generated by some very rich people transferring their money to their bank accounts stashed away in those 2 countries. Who knows? In the United States, total streaming minutes almost doubled, video streaming, up to, up 95% at this count. Video hogs about 60% of all internet traffic. So if video doubles, it affects the availability of bandwidth for any other purpose. An extra 30% load on the network, plus education and commerce and Zoom, etc., adding their loads. So in consequence, Netflix and YouTube had to reduce their streaming quality in Europe in order not to slow down some network speeds more generally. Now, in contrast to the fixed line internet usage, where the problems were minor, traffic gains on mobile have not risen very much. It rose just 10% in the United States. Basically, people are using Wi-Fi into fixed. But in poorer countries, it's different. In poorer countries, people depend more on mobile, and those networks congest more easily in peak situations. Some countries deal with this mobile congestion issue by upgrading to 5G. China, in particular, has doubled the number of towers in little more than a year to 600,000. That's a lot. It also reaps a dividend by selling now 70% of all 5G handsets in the world. But in some countries, there's been a real public backlash against mobile network upgrades. In the UK, 100 5G cell towers have been burned down by vandals. Why? They're supposed to cause COVID-19, or so the conspiracy theory goes. In America, the actor Woody Harrelson goes around saying that 5G causes COVID-19, and this conspiracy theory has begun to spread to poorer countries, for example, in Bolivia, where cell towers have also been burned. So one major conclusion of the network issue to me is that one has to have national plans for emergency capacity for civilian use. Our dependence on networks is so much that if they congest, we are truly lost. Imagine if electronic payments get through only intermittently. So networks should be built for peaks and not for averages. And such standby overcapacity inevitably must be subsidized as a social good, not as a private good. And some priorities for traffic have to be set. we got to think ahead, how much we need, how to get it, and who would pay for it. Now, the second theme are applications. For applications, which of course is at the heart of all this, technology actually is the easy part. Even the business aspects are manageable. The real problems is legal, institutional. My example will be e-education, but I'm sure that when we talk about financial services, people will pipe in about that. In the United States, for K-12 education, it's been one embarrassing disaster. Yes. Of course, there has been a digital gap. 43% of low-income kids have to do schoolworks on cell phones. But the real gap is used, but that real gap has been used by incompetent school districts to hide behind and to hide their inability to deal with the problem. Access to devices is a surmountable problem. Digital literacy among kids is pretty high. Affordable connectivity is a problem that is being addressed. The failings are primarily institutional. We have districts with thousands of teachers and administrators, educational bureaucracy. They have large budgets. They have technical skills. But half of the school districts cannot even get themselves organized to monitor students' attendance. In Los Angeles, the school district estimated that on a given day, 32% of high school students did not log in to learn, but they don't know who they are. Similarly, only 1/2 of school districts were monitoring students' progress. This is not just about money. Some of the best staffed districts like Seattle are doing the least. Districts in more financially stressed areas like Miami have actually been doing more. The same goes for institutional constraints, goes for telemedicine and for financial transactions. So to overcome this resistance of politics and institutions requires participation in a public conversation. For example, those dealing with blockchain and cryptocurrency here, it is imperative that they shed their techno-elitism and try to explain to the public at large why they are doing what they're doing is important to the public at large. They could explain, for example, the importance of blockchain speeding up supply chains. For example, if this blockchain environment becomes just seen as sheltering of wealth, they will be only one digital Bernie Madoff away from a public backlash. Third, public policy. There's a lot to say, but obviously there's not enough time. So I will mention only one issue briefly. What I am worried about is that all kinds of bad ideas will become acceptable due to the pandemic. That the coronavirus crisis will become a watershed moment, just like September 11 used to. In 2001, the terrorist attack brought us new government surveillance powers around the world in the name of protecting public safety. They led, for example, to the policy of de-risking and rules that, for better or for worse, affect DFS financial transactions around the world to today. And the same goes now for the pandemic. Privacy rules go out of the windows. Surveillance is in. Take the contact tracing technology. I don't have time to get into it, but the ways governments have introduced these tracking technologies is pretty scary because it is unlikely that they will easily go away once they're instituted, when the technology is there, once business becomes interested in the tracking applications, and once employers also would like to know where their people are and what they're doing. And that will also spill into financial transactions. They will say it's for public health. It's already called cyber hygiene. The tools are there, and absent some serious resistance and thoughtful resistance, they will be used. So what should we conclude? We're at an inflection point. The pandemic has accelerated and compressed the trends. And those changes are self-sustaining and we will not return to the status quo ante, but accelerate further. Where will this take us? Short term, the immediate response of the ICT sector was pretty excellent. Basically, it saved our collective rear end. Most of the private institutions adjusted in day and accomplished things that it took years before. And people too adjusted rapidly. The inflection point has become a tipping point. Working at home in a t-shirt used to be the exception. Now it is the rule. Showing up at an office with a coat and tie is becoming the exception. Soon we will have formal Tuesdays. But the most interesting and fundamental to me are the long-term implications that we will face. Impact on cities, on wealth distribution, on people's productivity, which I think has been negative. We don't have good numbers yet, but we also have eyes to look around and see. Give those people the right hardware and software, innovation happens. And the impact of money, what we're talking about today. So the short and medium terms are covered in great deal on the news channels and in magazines 24/7. But the long-term dimension is a good place for academia right here and to interact with academia. Empirical research, social science, economics, policy, technology, law. This is where universities' value added lies. And this is why our partnership with private sector governments internationally can be so fruitful. So I welcome you to this event at this university, which is still called Calabia, at least in the short term. So thank you very much for joining us today.
Thank you very much, Professor Noam, for your thoughtful scene-setting remarks. If you're just joining us, I'm Dr. Leon Perlman, head of the DFSO and your summit host for the day. I encourage you to tweet about the event at CUDFS20. That's the hashtag CUDFS20. I now have the pleasure of introducing the first keynote of the day from Chris Calabia, again, Senior Advisor for Supervisory and Regulatory Policy at the Bill and Melinda Gates Foundation, and a good friend of the DFSO. Over to you, Chris Calabia.
Thank you, Leon, and good morning, good afternoon, and good evening to all of our participants. My name is Chris Calabia. I'm the Senior Advisor for Supervisory and Regulatory Policy at the Bill and Melinda Gates Foundation, where I'm a member of the Financial Services for the Poor team. At the Gates Foundation, we believe that every person deserves the chance to lead a healthy and productive life, and we seek to address inequities by improving access to health and education, to clean water, to good nutrition and education, and to economic opportunity, especially for women and girls. Over the last 15 years, technology, and especially digital payments technology, has been a major driver of financial inclusion. A growing body of research provides persuasive evidence that access to appropriate digital financial tools makes it easier for the poor to make and receive payments safely and inexpensively, to save, to borrow, to invest in their children's nutritional needs and education, and to build a brighter future for their families. In that spirit, we have partnered with Columbia University's Digital Financial Services Observatory to help serve the financial needs of women, the poor, and the unbanked in especially lower and middle income countries around the world. Our broader goals to promote health and productivity are, of course, universal goals for policymakers. And yet today, the pandemic has cast a shadow across these goals around the world. This morning, I'd like to share 3 sets of personal reflections. I'll begin first with some thoughts on why digital financial services matter even more during this global health crisis. Second, I'll summarize the important role that technology has played in promoting access to financial services prior to the pandemic. This will bring me to my third and final topic, and one of the main topics for this summit and for DFSO's recent research, namely cybersecurity and its relevance to expanding access to financial services. We've reached a critical point in the development of digital financial inclusion. We must now invest in safeguards to preserve this lifeline for those living in rural or impoverished regions of the world. First, why does digital financial inclusion matter during a pandemic? The answer is found in the scope and scale of the economic hardships associated with COVID-19. The resulting burdens extend far beyond impoverished people who have traditionally benefited from the social safety net. If you're participating in this webinar from home, as I am, then you are probably among the estimated 1 in 5 people who can work from home. Working from home reduces your risk of exposure to COVID-19. Your ability to work from home, however, reflects, to a great degree, the level of your income. In lower income countries, the World Bank has found that only 1 in 26 jobs can be done from home. This dependency of nearly all workers in lower income countries on work outside the home raises profound concerns during a health crisis, especially if quarantining or lockdown requirements make it difficult or even impossible to work outside. Michael, if you could show the first slide. Vital Strategies, one of our global public health partners, conducted surveys of households in some of the countries in which we work in Africa this past spring. And they found, as you'll see on the screen, that 50 to 79% of households surveyed in those countries expected to run out of food in 1 week's time, while 73 to 88% of households expected to run out of money in 1 week's time without further assistance. Even in the United States, historic highs in unemployment during the pandemic raised serious concerns about the economic crisis that some households might face. For example, the Federal Reserve found in 2018 that 40% of households surveyed said they would have difficulty finding even $400 to cover an emergency. This statistic raises questions about how long some US households could go without income. Fortunately, many governments have sought to alleviate economic hardship on citizens and small businesses. In the second slide that you can see on the screen, you'll see that cash transfers are making up an important part of those responses. Relief payments to vulnerable consumers could help to make up for lost income. In turn, relief payments may help vulnerable families to adhere to physical distancing guidance, which could in turn result in better health for themselves and their families. Now, the World Bank estimates, as you'll see on this slide, that at least 180 countries have launched cash transfers to support vulnerable populations and furloughed workers. And a newer statistic suggests that by now, about 1 billion people worldwide have received such payments, about 1 in 7. Research that the Gates Foundation has sponsored finds that countries with inclusive digital financial services have often performed the best in delivering funds electronically to people affected by the pandemic. But interestingly, those same countries have also been better able to enroll previously unbanked individuals into accounts for the first time quickly. Countries with less adequate digital infrastructures have in some cases not fared as well in delivering cash transfers or in finding ways to enroll the unbanked into new accounts during the pandemic. Some recipients of relief payments have faced delays or misdirected mail when awaiting payment by physical checks in even upper income countries. Now, in this regard, technology has long been a game changer in financial services. That's been particularly true for people living in lower and middle income countries. And this brings me to the second point that I'll address today briefly. While banks remain at the heart of financial services in many markets, non-bank providers have found success in serving the needs of those living in impoverished or rural areas. About 15 years ago, mobile phone providers experimented with basic financial services, principally payments. The best example might be the innovative M-Pesa service launched in 2007 in Kenya by Safaricom, which is actually a telco and mobile phone company. There were similar programs experimented with in the Philippines at that time as well. Sub-Saharan Africa today leads the world in the use of non-bank mobile money services, where 21% of adults have a mobile money account, a near doubling since 2014. In total today, about 800 million people worldwide, many of whom represent lower income households, are estimated to rely on non-bank providers of e-money or mobile money. Moreover, worldwide, the World Bank reports that 52% of adults have sent or received a digital payment of some kind, up from 42% in 2014. Those figures will likely climb as more companies launch payment services, including social media platforms and fintech companies, which are technology companies seeking to provide financial services directly to consumers and businesses. As a former banking supervisor myself, I know that few financial institutions of any kind, anywhere, feel that they have all the resources that they need to protect themselves fully against cyber attacks. And this brings me to my third point, namely that cybersecurity is especially important in countries with constrained resources, yet large numbers of people who may be new to financial services and even technology. We in the development community have generally not articulated practical cybersecurity recommendations in the context of financial inclusion that would go to the heart of these technical issues. Several trends make it critical for us to do so now. First, digital financial services are evolving from walled gardens into more complex marketplaces for services. In some countries, I can make a digital payment to you, and you can send me a digital payment, but only if we both use the same commercial bank or non-bank mobile money platform. We've learned from history that the value and utility of payment systems, and especially digital or mobile payment systems, increase when I can make a payment to a grocer, receive my wages from my employer, and send money to distant family members, regardless of which bank or mobile money provider any of them use. Yet this increasing interoperability of payment services exposes consumers and providers to a larger range of participants, intermediaries, payments platforms, and vendors. Each participant may have varying degrees of capacity and capabilities to safeguard themselves against threats. Each may vary as well in its ability to prevent money laundering or fraud. Consequently, it's important for all participants in interoperable payment systems to protect themselves and thereby help protect the entire financial system against cyber threats. A second reason why we must address cybersecurity now at a technical level is that many countries are modernizing their payments infrastructure by adopting instant or near real-time payment services. Examples could include the unified payments infrastructure in India that facilitates instant interbank payments, or Safaricom's M-Pesa service in Kenya that I mentioned, that has long enabled consumers to make instant payments to each other. Here in the United States, the Federal Reserve has launched work to create the FedNow real-time interbank payment service. Faster payment services give buyers and sellers greater confidence that they can conduct payments on the spot with their phones. However, the increased velocity of transactions reduces the time for providers to review unusual transactions or stop them once initiated. When money moves at the speed of light, we need to fortify the platforms from which it launches against abuse and theft. Third, the rapid evolution in technology available to the poor makes it critical to ensure that their devices are secure. Today, simpler and generally less expensive feature phones account for about 60% of mobile phone connections in sub-Saharan Africa, and about half of those connections in South Asia, North Africa, and the Middle East. These phones with physical buttons and small displays opened the gates to formal financial services for millions of formerly unbanked people over the past 15 years. However, the GSMA expects that smartphones will constitute 2/3 to 3/4 of all mobile devices in lower and middle income countries by 2025. Smartphones offer users greater versatility. You can download third-party applications to simplify your access to financial services. However, the basic smartphones used in some lower and middle income countries tend to be more vulnerable to attacks. They often lack the more sophisticated hardware and software that secure more expensive smartphones today. For these and other reasons, we at the Gates Foundation are grateful to Professor Noam, Dr. Leon Perlman, and the team here at DFSO for answering the call to promote public dialogue and practical technical advice on cybersecurity and financial inclusion. In a few moments, Keith Bowie of the DFSO will present the Actionable Cybersecurity Risk Management Framework for digital financial services in the developing world. What you'll hear reflects the collective expertise of the highly skilled team here at DFSO. It reflects as well the wisdom of external experts in cybersecurity and digital financial services from around the world. The framework is still being developed, so please reach out to the DFSO with further suggestions. We'll then meet with a panel of experts on cybersecurity and digital financial services in lower and middle income countries. We'll talk as well with other guests about the impact of the pandemic on digital financial services and on the role that financial technology is playing in helping to respond. The morning will end with one of the hottest topics in central banking, digital currencies, and blockchain. All of these topics come up in countless fintech conferences and webinars today in some form or another. What makes today's summit different? Today, we want to examine the subject of technology and cybersecurity from the perspective of society's most vulnerable. For example, the questions that we will ask today is whether technology will close the gender gap in access to financial services. Will digital currencies promote greater inclusion? Or will it exclude those who are poor or those with lower literacy? In that vein, I hope you will continue to support and accompany us as we seek to build a more inclusive financial system and an inclusive digital economy that helps every person to lead a healthy and productive life. Thank you for joining our dialogue today. Leon, back to you.
Thank you very much, Chris, for those kind remarks and introductory keynote. Just to say that from my perspective, the Foundation's done phenomenal work before and during this pandemic, much of it behind the scenes, but really extending the full capacity of its focus area. So thank you very much for all of that. And especially again for your kind remarks and for all your and the Foundation support for the DFSO over the past few years. As you mentioned, we're going to talk about the Actionable Risk Management Framework. And I have the pleasure of introducing the second keynote of the day from my colleague at Columbia Business School, Keith Bowie, who has done a remarkable job leading the development of a unique and fit for purpose, actionable cybersecurity risk management framework. Again, if you want to see everybody's bios, it's the PDF of the bio booklet, and the agenda is on the homepage of the DFSO, dfsobservatory.com. And also I encourage you to tweet using the hashtag CUDFS20. Keith, over to you.
Good morning, everyone. My name is Keith Bowie from the Digital Financial Services Observatory at Columbia University. It's my pleasure to talk to you this morning. We will be discussing the creation of an actionable cybersecurity risk management framework for digital financial services in the developing world. We will call it the A-RMF through the course of the presentation. So our mission statement is to develop a process-based cybersecurity risk management framework for all actors involved in the DFS ecosystem. The work has been made possible due to a grant from the Bill and Melinda Gates Foundation. This is a process-based framework that provides both proactive and reactive guidance based on a set of executable or actionable processes. Our aim is to ensure that the DFS organizational operations and services are contained within a safe and secure environment, that we can provide confidentiality and integrity of data and information, we can secure transactions and limit access to those to only authorized persons or parties, and that we can act proactively and reactively to cybersecurity incidents to minimize the impact and disruption. It should be noted at this point, the A-RMF is currently a draft and is for review only, and is not intended to indicate compliance with any national or regulatory cybersecurity laws and or other regulations. So as a first step, we'll take you through our approach. Our approach is pretty standard for these type of things, where we've been performing research, creating draft documents, reviewing internally, going outside to expert panels, incorporating their feedback and going around again. We'll do this until we're confident that the artifacts are in a good and suitable state for final publication. There are 6 artifacts in total that we'll issue, and we'll go over those a little bit later on. This is not the world according to Keith or the world according to the DFSO. There are plenty of international standards that we can build on. So our approach has been to use these standards as a foundation and build our own IP on top of it. A very small sample of the reference sources is listed here. So our deliverables, as I said, we have 6 deliverables. We have an executive overview, which is a brief overview of the initiative. An initiative paper, which will go into more detail on our approach, initiative, and methodology. The risk assessment component, which is based on the FFIC cybersecurity assessment tool. The cyber hygiene maturity-based preventative process control component. And this is a catalogue of preventative processes per cybersecurity maturity, per cybersecurity domain and capabilities. And we'll go into this in a lot more detail later on. The threat matrix component is a matrix of potential cyber threats that could apply to the DFS ecosystem, with some suggested responses based on the organization's cyber maturity. And there'll be a user manual which will both be issued as a PDF and online to describe the individual component operation and how they interact with each other. From a timing perspective, we have been doing this since October 2019. Our first area of focus was to do the preventative process component. This took a lot of research and a lot of input from our expert review panels, and we eventually issued our beta back on the 14th of May. This was very well received, and we have incorporated the feedback from that review session into our Beta 2 release, which was released to the expert review group this past Monday, the 17th. In addition to the preventative process component, we also released the risk assessment component and a threat matrix component to our review panels for discussion. We also introduced the executive overview, which will hopefully give a little bit of colour to the expert review panel and anyone else who would like to read it. So our methodology was based on a couple of key principles. One, we had to define the cybersecurity maturity model. Now, there are plenty of maturity models out there, and we took the kind of best of breed from them all to define our model. We've ended up with 6 different levels, which we'll discuss later. We also defined the risk assessment, which is based on the FFIEC CAT, as we've mentioned before. And we also took into account the various actors in our ecosystem and put a little bit of organizational questionnaire in that as well. We'd expect the organizations to do a self-assessment using this questionnaire, the results of which would then produce or assign a cyber maturity to an organization. Based on a cyber maturity, the organization can then refer to both the preventative and the reactive controls and processes. So now for the components themselves. The A-RMF risk assessment component is based on the FFIEC CAT. We have added an organizational overview questionnaire that reflects characteristics consistent with our cyber maturity philosophy. This requests information on organizational size, technology capabilities, cyber capabilities, organizational maturity, such as risk, the risk function, compliance, CEO board involvement. We have then created a questionnaire based on the FFIEC questionnaire itself, but we've refined it to reflect the DFS actor capabilities, which vary greatly. And lastly, we'll define a scoring methodology to assign a cyber hygiene level. The cyber hygiene maturity-based preventative process component is based on a set of cybersecurity domains. The domains are really as per international standards, and they're a set of classification of a set of capabilities or principles. So for example, we have asset management, identity access management, incident response, governance, etc. Within each domain is a set of capabilities or principles, which in total describe the domain. So for example, using asset management from before, it could be identify all hardware assets, identify all software assets, etc. The process goals tell us how to satisfy a capability or principle. So keeping with the asset management theme, to meet the capability of identifying hardware assets, the process goal would be to compile and document the hardware assets within the organization. The actionable processes themselves are the key part of this. These are the actual processes that should be executed to satisfy a process goal. For example, to meet the process goal of identifying and documenting hardware assets, the steps would be identify the hardware assets, document any unique identifier such as manufacturer, model, serial number, location, business owner, technical owner, etc. And a success indicator would be the result of the successful execution of the process, which in this case could be a hardware asset catalogue. The domains, capabilities, and process goals are consistent across all cyber hygiene maturity levels. The actionable processes and success indicators vary across the levels. So from a cyber hygiene maturity methodology perspective, there are 3 main pillars: cyber maturity, process maturity, and organizational maturity. As you can see, we have managed to define 6 levels. Now, it should be noted that levels 1 and 2 are very similar. Levels 5 and 6 are very similar, but there is a big jump between levels 2 and 3, 3 and 4, and 4 and 5. We did consider consolidating the number of levels, but we decided in conjunction with our expert panels that it was in our best interest to keep the 6 levels as per the slide here. So from our cyber maturity level, we go all the way from limited or no cyber hygiene all the way through to excellent cyber hygiene, which has got proven abilities across the organization to optimize and adapt the procedures and processes. From a process maturity perspective, we go from no cyber processes to speak of, no documentation to speak of, all the way through to very good process maturity. There is standardization across the organization and everything is documented. The organization maturity goes from no formal org structure with no cyber capabilities, so potentially, you know, an agent sitting in a bodega somewhere, all the way through to a sophisticated org structure where you have segregation of duties, clear lines of delineation between different groups, and which would potentially be like a regional or global bank operating within the area. Our current Beta 2 version issued last Monday currently consists of 82 capabilities, 107 process goals, and 113 processes within each maturity level. We've highlighted a couple here to give you a flavour of what's included. Now, it should be noted that not all processes are unique. Across all the maturity levels, there are 393 unique processes. All right, now we'll discuss the threat matrix component. The aim of the threat matrix is to provide a set of reactive processes that can be executed in response to a breach or incident. First, we designed a set of threats applicable to the DFS ecosystem. These include common items like social engineering and those applicable to the DFS ecosystem itself, like mobile communication infrastructure, mobile devices, and the applications. For each threat listed, there is a summary of the threat, the vulnerability, which is a result of a successful attack, and the risk or repercussions of a successful attack. We then group these threats into like-minded categories like social engineering, and then we have defined a generic response for each threat. Based on that generic response, we have then tailored the responses for each threat by maturity level where appropriate. Additionally, where applicable, there is a cross-reference to the threat group or an individual threat in the preventative process component. The current Beta 2 version of the A-RMF threat component is listed here, where we have 85 threats across 9 different threat groups. Thank you for the time this morning. For more information on the DFSO, please visit dfsobservatory.com. And to be an expert panel member or for more information on the A-RMF, please contact myself, Keith Bowie, at kb3171@gsb.columbia.edu. Thank you for your time.
Thank you very much, Keith. Thank you again for all your effort and also the team at the DFSO for a fantastic job in developing the risk management framework. You can see it's pretty comprehensive in a relatively short space of time, but of great granularity. So I'll also echo Keith's call for contacting him at DFSO if you want to be one of the expert panelists. I see there's quite a few people that have joined us. Just a reminder, I'm Dr. Leon Perlman. I'm the summit host, and please tweet at CUDFS20.